Today, we are on our 33rd episode of our Bay Area Housing Market Town Hall. I can't believe how long it has been. I am really excited to talk to Peter today about DST. You'll be surprised how many people don't know about DST, and then they don't know exactly how to use 1031 exchange. And one of the reasons why I invited Peter was because I got a few phone calls within the week. And for some reason, and these buyers who had already sold their properties did not realize that how 1031 exchange work. And I had to give them the bad news about it. You probably don't have enough time to exchange into another property, or they were already disqualified because they didn't do it right when they were selling their investment property. So today I'm really excited to have Peter to share with us about the pros and cons by using DST as an alternative 1031 exchange. Now, Peter, actually, a lot of people probably have heard of his name, and he is the founder of Sequin Real Estate Wealth Management. And he's been around for many years. We used to invite him to our CCIM chapter meetings, and he would speak to a lot of our commercial real estate brokers and investors. Whenever we talk about DST, everybody just get very intrigued because we always get so stressed out, right? Helping our clients to find a replacement property within a specific time frame. But DST really does solve a lot of some of these stress from our clients. But of course, there are still maybe some disadvantage as well. So we're going to go into it in a little bit. First of all, I want to remind everybody to subscribe to our channel. We have a lot of videos. We also started to create these shorts because I know it gets pretty long, so we split it up. So it takes about a minute or so for you to digest some of the data. Hopefully you guys enjoy that. Lastly, of course, don't forget to connect with us on social media, Facebook, LinkedIn, Instagram. We try to keep our audience as informed as possible because Halen Group, we really believe in educating our clients so that we can empower them and help them make the right decision on their real estate. All right, so I'm going to turn the floor back to you so that everybody can learn about 1031 exchange, specifically for DST.
Okay, good afternoon, everybody. Thank you, Helen. That was invigorating information. My name is Peter Fisher. My company is Sequin Real Estate and Wealth Management. We're a San Francisco-based organization. We are a group of wealth advisors. So we're securities licensed, and we work primarily with clients on 1031 tax deferred exchanges into securitized investment structures like a Delaware Statutory Trust. And that's why Helen brought me in today, was talk a little bit more about the DST and how it works with a 1031 and what we're seeing in the commercial real estate market today. So we're going to jump right into it. I might skip over some slides, so bear with me. I think, okay, there we go. I'm going to skip over how to navigate a 1031 exchange. I do want to make some comments just as a refresher to everybody on the call today. We're going to talk more about the DST, the Delaware Statutory Trust. What is it? How does it work? And how do we use it in 1031 exchange replacement property scenarios? We don't need to talk about 1031. Everybody knows it's a way to defer tax on the sale of an investment property. But when we do 1031 exchanges, this is where it gets interesting. And I think a lot of individuals doing 1031s think I'm selling a rental home, I buy a rental home, and that's it. That's the end of the day. There are expanded options for 1031 exchanges. Helen may not do this. I don't do a lot on the screen. First of all, we think of real estate. We think of investment replacement property. That's the simplest and easiest transaction, trust me. But you can also do oil and gas mineral rights. You can do land leases. You can purchase ownership in multi-owner structures like a DST or a tenant in common. I didn't put the tenant in common up there. It's not a really common strategy these days. You can combine any of these strategies together. So you can buy your own property, you can invest in a DST and have a land lease, and it all qualifies under the Internal Revenue Code 1031. Failed exchange, if something goes wrong, you don't identify by day 45, you don't close by day 180, you always have the opportunity zone, which is introduced in 2017 to our tax code. Totally separate presentation. If anybody's interested, reach out to me. I've used this word Delaware Statutory Trust. So what is a DST? A DST permits for fractional ownership. So many investors come in and share an ownership of a typical institutional asset. So we're talking about 300 to 500 unit multifamily complexes, Amazon warehouses, large office buildings, industrial assets, self-storage, et cetera, et cetera. There's many types of like-kind properties out there, and you'll find just about all of them within that DST structure. It's a passive investment strategy. So investors come into it, and it takes away that responsibility of the individual's day-to-day operation of their real estate. We're going to talk more about that because that can be considered a negative, of course.
And Peter, I think when people look at that, they'll be like, oh, so that's a syndication.
So it's that word syndication does not apply to the Delaware Statutory Trust. It is a securitized investment strategy. And what that means is you do have to work with a licensed individual, so securities license or registered investment advisor to execute a DST transaction. And there's oversight with FINRA and the SEC.
So to clarify is that if somebody wants to do a 1031 exchange, you cannot just say, I'm going to invest into a syndication by someone else who just putting together some funds and then buying another property. You have to go through a DST.
Right. Yeah. And the oversight is next level.
Yes.
The documents you will receive a 300-page booklet, and there's also 300 pages of documents behind that is an electronic drive for you to access. And this is all of the due diligence that goes into the Delaware Statutory Trust. It goes through many different hands before it even gets to the investors of approvals. Steps to a 1031 exchange. I'm going to point out one here. The most important thing is to contact a qualified intermediary with adequate time. Don't call the day before you're closing on your relinquished property. Give them plenty of time to set up your exchange account. Once that happens, we can worry about the rest. Don't forget to contact your qualified intermediary. So let's cover the Delaware Statutory Trust a little bit. We're going to go through the evolution. We're going to look at some positives and negatives. Is it appropriate for you? How does it work? And finally, some of the rules, which we call the 7 deadly sins. The Delaware Statutory Trust, of course, that terminology trust goes way back when the DST that we know today, although was issued with a revenue ruling back in 2004. So you can see up here, revenue ruling 2004-86. A couple DST sponsors worked very closely with the Treasury Department back then and came up with this structure that ended up being very client friendly. And that's those 7 deadly sins, which we'll touch on, which puts a lot of, I guess it takes away a lot of control from the real estate sponsor to do things that are not in the best interest of the investor. And Helen, that word syndication, to me, I get bad vibes thinking, oh, the syndication is in control of somebody. Mm-hmm. Are they executing transactions on their behalf or the investor behalf? It's not true in every case, of course, we know that, but the DST favors the investor in that case. So is the DST appropriate? And I'm going to cover a little bit here, but when you invest in a DST, as an individual, you're giving up control. So is that a positive or a negative to the individual? Most of the clients we have come to us wanting to invest in the DST exactly because of that. Yep. They're done. They don't want control. They don't want to deal with what we call the 3 T's of real estate investing: tenants, trash, and toilets. I know it's a bit gory, but that's the truth, right? There are fees that are a little bit higher than if you're going to do a direct real estate transaction. But again, that's part of giving up control. You're wanting to come in and lose control, and the real estate sponsor is going to make those investment decisions for you. You're losing liquidity. Now, that is dependent on the individual DST. Most DSTs are 7 to 10 years, so you don't have access to that liquidity in that time period. Now, these next two bullet points apply to investing in any type of real estate, economic volatility, and environmental and market risk. You cannot avoid that. It doesn't matter what you're investing in. That's not specific to a DST. That is specific to the real estate market.
When I want to go back, or maybe you will touch
Sure.
on that a little bit regarding the lack of liquidity.
Mhm.
So you mentioned that once you invest into the DST that you have chosen, then you typically last about 7 to 10 years. That's for, I assume that is what your company would decide whether you guys going to sell the portfolio or going to exchange into another property. Is that correct?
Right. At that time, we work very closely with real estate sponsors. So the sponsor is actually the entity that is in charge of acquiring the real estate, securing the financing, managing the investment for the investors. And at some point, say it's 7 years, they decide they want to sell. The equity is returned to the investors, ideally with profit. And we will work with our clients to decide whether we want to do another 1031 exchange, cash out, or maybe go buy another property on their own. Most of our clients are rolling right into DSTs because they're used to the process and the freedom of not having to manage real estate.
Yeah, it's really hard to go from passive to all of a sudden I have to work for it again. Right. Another question would be, what if an investor who invested into DST in the middle of it 3 years later is like, oh my gosh, I really want to take the money out of it so that I can buy this other property I really want to actively manage now. Is there any way to do that?
The short answer I'm going to give is no, but yes, you can. So when we work with clients, the way the DST is structured, you can sell your interest, right? You own 1% of this $400 million or $200 million property, right? You can sell that to another owner. That's fine. It's not typically easy, and it's not recommended by us. So that is one of the reasons why you do want to work with a licensed advisor while investing into a DST, because we are going to understand your entire portfolio. We're wealth managers. The DST is a piece of your portfolio. We look at everything and make sure you have that liquidity. If your intent is to buy another property in 3 years, this might not be the right investment for you.
So this is a really important point for investors, is that because a lot of times they say, okay, I cannot find a property to buy right now, and maybe I should just put the money into DST temporarily for a year or two, then I can take it out to buy something. That may not be that. It may not be able to work that way, right? Good. So I just wanted to make sure that our investors get that clarification.
So there's 3 major phases to the DST, and I'm going to start at the bottom of this slide. Who is the sponsor? The sponsor is a real estate group. These are typically large national real estate groups that we work with that have been vetted. We want companies that have been in business for let's say we like to see them be tested. So at this point, that's, about 10 years is a good number for us. How did they fare through the last downturn? They're the ones that are acquiring the real estate, again, securing financing and managing the DST for the investors. So they're issuing the beneficial interest. Phase 1 of the DST is due diligence and acquisition. This is no different than anybody would go out and do due diligence on a property, except they take it to the next step, because this is institutional due diligence. And because of the amount of regulation on top of the DST, they go through it with a fine tooth comb, right? And that's 300 pages of documentation that you receive of every piece of due diligence that you can imagine. These are large due diligence teams that have a lot of equity at their side to do their job right. That first step, if anybody picked it up, the sponsor buys the real estate first. The sponsor puts their own money in there. They then secure financing, which is non-recourse. That means there's no liability to the individual investors. There's no liability to the sponsor. The liability is on the real estate itself from the bank's perspective. Because the properties have been acquired and the title is taken by the DST, essentially, investors can come in at their timing. If I look at my list right now, we have 20 separate DSTs. I haven't added up the numbers recently, but there's often sometimes between 500 million to $1 billion in equity sitting there waiting for investors across 20 different DSTs. So there's a lot of options. It might be multifamily, self-storage, medical office, single family rentals, on and on and on. So there's a lot of options, and because the sponsor buys the property first, it makes it a lot easier from the individual perspective. Operation and property management, nothing out of the ordinary. Rents are being collected, obligations are being paid, distributions are going to the investors of the excess income from those rents after obligations. 7 to 10 years later, the property is liquidated, it's sold. The equity has to go back to the investors. There's no way around it. It's one of the 7 deadly sins placed in the DST is that equity must be distributed to the investors, ideally at a profit.
So at this point, once the money is distributed back to the investors, and of course they're like, well, wait, I don't want to take the money back because then I have to pay capital gain tax.
Correct.
So
you
they
have
can choose to continue with another 1031 exchange as in a physical property yourself, or roll into another DST.
Absolutely. The DST is qualified as like-kind real estate based on that revenue ruling 2004-86. So you can exchange into any like-kind asset.
So now, again, that's 1031 exchange. So there is also that timeline that you have to follow. Now, how much time do you guys give investors before you tell them that, hey, you're going to get the money back now? Because then, like for physical property, it's a little bit harder. It's like, well, it depends on when we're going to get a buyer and then the escrow length. What about for DST? Will you say like in 6 months or so, we're going to give you back the money, so now you should start looking for a replacement property?
Right. So in the perfect situation, the sponsor markets the property, and when they start doing that, they're going to notify the investors. So that's going to give you some leeway. Now, in the past couple of years, there's been a lot of unsolicited offers, and sometimes it's 30 days is the shortest I've seen. But these are institutional assets, so there's still a due diligence period. So somewhere between 30 to 90 days is pretty typical.
Got it. Great. Still have time. So it's nice to actually plan ahead.
That's right. I just flipped over to the next slide. It's on my 7 deadly sins. If you want to write that down, the 7 deadly sins of DSTs, you can do a really quick internet search and you'll see them. I must have removed that slide by accident. That one's on me. We're right at the sort of end of my presentation. I'm going to cover this slide, Helen, and talk a little bit about why do individuals use the DST? That number one reason for our clients is no management responsibilities. Think about the life cycle that you're in, and do you want to take on another rental property? And for us, those clients call us and say, I don't want to. Number 2, which is probably really even with number 1, is boot. And for those of you who understand the 1031 language, boot is leftover, or boot is money that you take out. But in this case, it's more about the leftover. You have $1 million in equity to exchange. You find a property for 800. It's the perfect asset. It's right next door. Maybe you don't want that as a rental, but it's the perfect property. You have to buy it, but there's $200,000 left over that you don't want to pay tax on this time. You can put that into a DST. Most DST minimums are 100,000, and those numbers are flexible as well. So the DST can be there for your boot dollars down to the penny. Backup plan. This is if you're pushing up against day 45 and maybe you didn't find anything and you're stuck, or maybe you have a property but you're not in contract, put a DST in as your backup plan, whether it ends up saving the entire thing or it's a backup just to that first choice that you have. We do that a lot. It doesn't cost anything to identify a DST. But the equity's there. That's the important thing because the property's already purchased. Estate planning, the DST is an excellent way to pass wealth on to the next generation because, in that case, when we're thinking about that extended estate planning, most individuals are in that life cycle where they don't want to deal with real estate anymore and they want a simple transition to their children or to their heirs. I will leave it there. Is that good, Helen?
Yeah,
I'll
absolutely.
put my disclaimer up here for a moment, because we did talk about tax strategies and investment strategies. Just a reminder, the DST is available for accredited investors only.
Well, so I think this will also be a good time to talk a little about how do you guys evaluate your the real estate that you guys decide to purchase, and especially during this current environment.
Yeah, so I don't think we need to mention that the environment's changed. But as interest rates have gone up, we have seen borrowing going up. So sponsors, the ones actually purchasing these assets, are getting a lot more creative. 12 months ago, the average loan to value for a DST was 50%, let's say. Today, the average loan to value on a DST is 40%. With different terms. So we're seeing the terms shorten, and we're seeing earlier amortization of the loans. Because there's this balancing act now of, do we get a loan? That loan has to be a positive spread to the portfolio. So it's become more difficult to find the returns that investors are looking for. Talking about average returns of a multifamily DST today. This is a 300 unit multifamily property in Phoenix, Arizona. It may generate a 3.25% cash on cash return in that first year and go up from there. Commercial real estate or multifamily specifically, just to pick on that a little bit, in the past had typically had a 6 to 9 month lag from interest rates. So what does that mean? Interest rates bump up, rents can't reset for 12 months, right?
Mm-hmm.
So typically during that 12-month period, you have maybe half of your rental units are going to reset the prices. So they're going to reset at current inflation or interest rates. But now sellers are looking at 12-month models. So on a commercial asset, multifamily, the sellers are pricing it for what it's going to look like in 12 months. So now rents have to catch up to that 12-month period. So rents are going to go up with inflation. That's the nature of the beast. So I think there's going just a balancing act now that we'll see balance out in the next 12 to 18 months, as long as interest rates, I think from your charts, don't go out of control, where we all think they are going to. So property prices and returns still need to balance, and it's going to take another 12 to 18 months, in my opinion, on DSTs.
I see. So in this case, for somebody who said like, okay, I have let's say $500,000 now, I want to invest. Is there like a minimum amount that they can invest into DST? Or does it have to be like, hey, you have to have at least $100,000 or a maximum of a certain amount of money?
Sure. So most minimums are 100,000 for a 1031 exchange into a DST, and cash investors non-exchange are 25,000. That's not a hard, fast number, the 100,000. That is flexible. So if you have 75,000 left in boot on your exchange, don't hesitate to reach out to us.
Okay. So if somebody said, I don't really need to exchange anything, I just want to invest into something that I don't have to worry about, can they just invest in DST as well?
Absolutely.
Good. So it's not only tied to those 1031 exchange investors, but also anyone who just want a passive income and they trust your
100%.
company investment decision, and they can invest their money as well. So I mean, there are just so many of my clients before would ask me, it's like, oh my gosh, we sold it, we didn't identify up to 3 properties within 45 days. So to protect themselves, let's say, can they do 2 physical property and then 1 DST?
Yes, absolutely. You can mix and match from your exchange into as many assets as you like and as many structures as you like, as long as it is 1031 eligible.
Does it work for somebody who maybe they have several partners in a corporation and then they want to go their own separate ways and then invest separately into a DST?
That is a loaded question, because the answer is yes and no. It depends on how the structure of their organization is. Using a basic family LLC, with say 4 members. If it's not structured as tenants in common, then all 4 members would have to make a decision together. If it's a tenant in common LLC, then you have 4 separate owners, they can go their separate ways. So that's a tough question to answer on a call like this, but run it by us. We can give you a quick answer, and if it's too complicated, we have you talk to your attorney.
That is a great, because like we do see a lot of people who partner into a corporation or whatever partnership they're in, and then now they want to go separate ways, which happens way more often than people think. So especially when they start to get older, they have their own kids. Now there's time to say like, okay, what are we going to do? Because you can start with 4 people, each person have 3 kids. Now it's going to go to 12 people and in the end. So a lot of times towards that period of time, that's when people say like, okay, we need to go separate ways. So it's really important to talk to a state attorney before you set up that corporation. All right. So Paul has a question. How's the title being held in a DST?
So you're a beneficial interest owner of the DST, so you have fractional ownership, and you hold title within your existing title. So whatever your relinquished property was titled, it'll be titled the same. And then the title of the property, of course, is within the DST, but there's many owners, and everybody has equal ownership rights. There's no general partner. Let's put it that way.
And so actually now go back to how are they going to receive their reporting, and how many owners do you typically see in one DST?
It depends on the size of the DST, but there's typically 50 plus. Some DSTs are bigger. We just had one come out that's raising $200 million. So there's going to be hundreds of investors in that individual offering. It's actually 3 multifamily properties. The tax reporting, I was trying to remember the question, well, is a 1099 at the end of the year, or some sort of income statement called a grantor letter. Typically, though, it comes in a 1099 form. So no K1s. Again, let's keep it simple. It's not a K1.
So they do expect to receive monthly income.
Yes. Yeah. Generally, I would say 95% of the DSTs we work with pay monthly.
And then of course SL. So now you talked about cash on cash return about 3.5, was it 3.5%?
I think that's a good, right now 3.5, sure. Yes, that's probably the average you're going to find today. Call me in a month and it's going to be different. But if you look at our inventory today, the average is about 3.5%. First year, cash on cash, you're usually going to see rental increases, especially on multifamily, maybe not on Amazon. And then when the property is sold, ideally, you're going to see some appreciation. So your average annual returns, I'm going to be very conservative here, Helen, is probably 6 to 10% over the next decade.
Well, that's actually not bad. I think a lot of investors will be really happy with a number like that, considering, I mean, it is a physical asset that you own. And then I feel, to me, is that you have this, I'm sure you present like a very detailed analysis and then have your own projections. But no matter what, real estate is definitely a lot more secure compared to the stock market. Although they do say that stock market you can go about 10%, but like if you're talking about it today, right now with a lot of stock investors, they've been probably like, no, I should have pulled it out earlier and invested into something else, into real estate or something.
Of course. Well, and as a wealth advisor, I always tell you to try to not time the market, but
yes,
it's nice to if you can make it happen.
That is so interesting for you to say that. I mean, it's interesting and it's not. It's kind of like people always like, oh, you guys say that all the time. As a realtor, that's what we tell our clients, right? Hey, you can never time the highest and you can never time the lowest of the market. The timing is whether it's right for you or not at that point. I think in any market, you can still make money. That is truly what I believe in. And I think a lot of people actually made a lot of money during the last recession, which is way, way, way worse than where we are today right now. So it's just a matter of how do you analyze your real estate and your plan for your real estate. What is it? Is it a long-term thing, or is it a quick flip? Just like stock market, do day trade versus long-term investment, or real estate would be, are you doing flip, or are you doing long-term rentals, or is this for yourself to live in? So those are the things that people need to think about before they say that, oh, I want to buy a home for myself at the lowest of the market. You just can't time it.
That's right.
Yeah.
But if you can, good for you.
Right. So there is this word in Chinese that I actually put in my book that called crisis. During recession, we always say this is a crisis moment, but in Chinese, it actually, the word crisis have two words. One is danger. So is a dangerous time, but then another word is opportunities.
That's right.
In the time of crisis, it could be dangerous, but there are also plenty of opportunities. And I cannot tell you how, not that you're being opportunistic, it's a matter of how to analyze your investments to make it the right investment during that time. And in anything in life, if you invest in something blindly, that's the dangerous moment. Doesn't matter if the market's going up, you're not really using your skill set. You just got luck, I think.
Well, I love that, because that goes back to item number 3, the sad face and the smiley face. So crisis means, yes, there's good and bad.
Yeah, going up at interest rate. There are definitely good and bad. So go back to DST. So if somebody just say like, oh, in that case, then I'll just create my own DST, and then I can do 1031 exchange. I don't need to pay someone else to do that. I actually have somebody who asked me that question before.
Sure. I get probably a phone call once a month from somebody interested in doing this. And with the way the DST is structured as a securitized investment, so you have to have somebody who understands securities laws working on your side.
Yeah.
And the cost and the diligence that goes into setting up a DST for an individual is not worth it. There's other structures to utilize if you want to, set up a syndication. In this case, you'd probably go towards a syndication rather a DST.
But at the same time, syndication doesn't qualify for 1030 exchange.
You can structure those as tenants in common. So you can
that's true.
1031, yeah.
You're right. Okay. So that will be a way of satisfying that 1031 exchange requirement, is to do tenants in common within the syndication.
Absolutely. So that was pretty popular in the early 2000s. We saw the tick market up until 2006 and 2007 when it started to unravel because of more of an unregulated market in the tick industry. You could have 2 attorneys put together a deal, syndicate it, sell it, and then they're done. They hire a management company and walk away. That can't happen with the DST. The real estate sponsor is tied to the deal as the master tenant.
I see. Actually, I have to go back to the question I had earlier about the identification within 45 days. So can you identify 2 different DST?
Oh, yes, absolutely.
Yeah.
You can identify as much real estate as you like on day 45.
Okay.
Now there's rules you have to follow. So most of us utilize the 3 property rule, which is what we call 3 for free. You can identify 3 properties of any size, any value. If you go over 3 properties, you fall into the 200% rule, which means you have to keep your identification value under 200% of your relinquished property. But we if you're starting to get complicated, I'm happy to walk you through it. Give me a call. We'll help you with it on the identification.
Absolutely. We had a client who actually identified 4 properties before, and it's like at the end you got to buy all 4 because it has to be 200% over what he had relinquished, and that was very stressful when you have to close all 4 properties. You have to make sure you have to close all of them, otherwise this 1031 exchange would be a fail.
Yep.
So, and again, go back to like, you got to work with somebody who understands 1031 exchange. Even the realtors, we are not the 1031 exchange intermediary. At least we know the basic rule and then connect you with a professional. We have 1031 exchange companies that we work with, and then you identify the properties or DST to exchange into. So, and also you need to involve your CPA to make sure that you're doing it correctly.
That's how I end most of my sentences. Talk to your CPA.
Yeah, right. And we do get these questions a lot about like, oh, how much tax do I owe? We just not qualified tax advisor, so we cannot answer that question. Of course, we can give you some ideas on like the approximate amount, but again, we don't know your full picture. Somebody who like a wealth manager would look at your whole portfolio, they still would tell you to go get your advice from a CPA.
That's right.
All right, Paul, have another question. Is there a minimum amount of time an investor must hold money in a DST?
So the DST has a fairly specific life cycle based on the business plan going into it.
Mhm.
So Paul, you'll want to hold that equity in there until the sponsor sells the property itself. Now, the minimum time to do a 1031 exchange is relatively seen as 2 years. So if you're going to sell your interest, or if a DST has a short time frame, because some do, that shortest time frame is typically 2 years. But again, these are not liquid, so they're not readily available for as an individual to sell at your leisure. You'll want to wait for the sponsor to sell the real estate.
I know I'm pushing it, and but you did say that earlier is potentially, you can sell your interest to someone else.
Correct.
But not likely, not highly
So
likely.
it's not something you want to bank on.
Right, exactly.
You don't know if there's a buyer there.
Exactly. Yep.
Is that buyer, are they going to buy it at your cost? In most cases where we see this, it's at a discount. So you're going to lose some equity in that transaction.
That's a very great point. So that's why Peter gave me a no and then yes, but it's more of a no.
Right, it's more of a no.
Yeah,
at least on my end.
Yeah.
You can talk to different DST wealth advisors and they may give you different answers. And on my side, I do not want to put us, meaning myself and the client, in that situation to say in 2 years we're going to sell this equity. It may not be there. You might not have access to it.
Yeah. Well, this is so informative. I love it. And thank you so much for coming on, explaining 1031 exchange. Now, I hope that our audience now know that there are other ways of doing 1031 exchange if you don't want to manage your property anymore. And I see that a lot of people, especially when they are, they're getting older now and they really don't want to deal with management anymore. This will be a great way to do a 1031 exchange. All right. Well, thank you again, Peter, for coming on to our webinar. And as a reminder for everyone, be sure to subscribe to our YouTube channel. All right. Have a good day, everybody.